All right, Vinod Karki also with us this morning. Vinod, good to have you with us. So let's talk about, firstly, what you're expecting from 2020 in terms of the kind of upside you see, whether it be on the index, the kind of recovery in earnings. Give us some broad outlines into how you're expecting the year to shape up.
Yeah, good morning. Thanks for having me on in the studio for your show. We just finished actually two notes, and they gave us incremental information and insights into what is happening. So first, we just finished how the capex picture is looking amidst all the negative narrative that's going on right now. So we looked at the listed companies, almost like 1,000 companies, and the picture that we are getting is that although the narrative seems to be pretty bad, but if you look at the underlying numbers and we looked at the cash flow capex that all these top 1,000 companies have done, it appears that it is more or less in line with what was done last year. So there is not a material dip in private listed capex, but obviously there is no growth as such. So, but given the background that we had during this period of election-related uncertainty, so everyone was saying that once the elections are done, then we will start with our investment projects, and the government, which was spending, which was the driver of the capex cycle till now, also took a back seat, during this first half of FY20. So given this context, I think this number is not very disappointing. So that's point number one. Second is, if you look at the overall aggregate financials of these companies, these industrial companies, one thing that struck us was that the operating cash flow less the interest at around 2.7 trillion rupees is actually a little higher than the capex that the companies did at around 2.4 trillion. Now, obviously, one can argue that there are a lot of these high cash flow asset light businesses which are generating the extra cash flow, but overall picture is not bad. And if you look at the outstanding, I mean the cash and investments on the balance sheet is around 13 trillion. So given any kind of uptick in demand revival, the balance sheets are well capitalized, if I may say so, to take the opportunity of the capital spending coming back. Yeah, so this is about the capex. So that is one of the key worries that we had, that the capital spending is not picking up. But overall, the spending has been kind of in line with the last year. Now, what can be the drivers next year for private spending, and what are the risks? So that is very important, because if you see the GDP number also, the number which fell the most was the gross fixed capital formation, the investment rate actually. Private final consumption expenditure was actually not that bad, although it is way off than the earlier trajectory that we used to get, the growth rate. But it was not a big disappointment. But investment was clearly there as a disappointment. Now, if you look at the drivers, what is happening is...
If I may, I just wanted to talk about, the general consensus in the market, and that's the view that the macros aren't quite playing catch up with the heady rally that we're seeing on the index. And even when we are seeing the markets move from one milestone to another, it's those select stocks that are, moving the market, available at very expensive valuations. So how does one really play the market at a time when you aren't seeing a broad-based rally play out and there's a stark divergence in the macros?
Absolutely. So if you look at the performance of the market, it is the divergence is more from the small cap and micro cap, if you see, as compared to the earlier cycles. So while the large caps, the Nifty has kind of given good returns since September, we haven't seen this outperformance. Typically what happens is when there is a kind of optimism and euphoria kind of environment, the small caps and mid caps outperform by a wide margin actually. So that is clearly missing right now. If you see the value gap, what we have seen is that the small and mid cap is where bulk of the the more value or margin of safety is there. So in this environment, if the market keeps if it continues to be robust and buoyant the way it has been so far, we expect that you could see more outperformance from the small cap and micro cap space going into next year. Because it is not the value gap has significantly widened for this group of stocks from the peak of January 18 when they were at a elevated level.
Fair enough, and that is one of the key concerns that we've been talking about. Let's talk about also, Vinod, where you're placing your bets in a market like this. Are you betting on some of the, select NBFCs that have managed to withstand the impact of the liquidity crisis? Is there consumption? Do you like metals owing to, the kind of run-up that we've seen basis the US-China trade war concerns having abated? Right. Which sector is it that you'd like to venture out on?
Yeah. So broadly, if you see, what we are expecting is that there will be a gradual recovery in the overall GDP over the next 1 year or so, rather than a sharp recovery. In this environment, the pessimism or the situation was really worsening for a lot of the consumption stocks and investment stocks. But as we recover from this low base, what we believe is that the financials, consumer discretionary, and largely some of the industrials which will be benefited by the revival in investment cycle to some extent, not a full-blown kind of revival, will be the spaces. So within the financials, obviously you'll have the banks, and so there you have several kind of plays where there was a hit on the commercial vehicle side, the passenger vehicle side, financing, housing finance took a hit, and in general credit cycle was weak. So that will be overall be beneficial for the financial sector. So that is one space one should clearly look at, where the growth and the NPA, the growth is reviving, and the NPA cycle or these companies have not shown spike in NPAs. In terms of industrials, as you said, while the global situation seems to be getting a little better, in this environment, some of the commodity stocks, within metals also could be benefited. So we have Tata Steel as one of our top picks. And in terms of the revival of government spending, which can happen once the election-related uncertainties are out, some of these infrastructure-related stocks like L&T, Engineers India, they are our top picks, right? And within consumption, we prefer the consumer discretionary over staples this year as the growth revival picks up, right? So these are some of the spaces we like. And within capitalization, we think that the large caps will give you, after the run-up, high single-digit kind of performance for the large cap Nifty, while we feel there could be outperformance from the small and micro cap over the mid caps. Mid caps might not give you as much as an outperformance that we have seen in the earlier cycles. That's our view.
Fair enough. And let's talk about, also, Vinod, where you're placing your bets in a market like this. Are you betting on some of the, select NBFCs that have managed to withstand the impact of the liquidity crisis? Is there consumption? Do you like metals owing to, the kind of run-up that we've seen basis the US-China trade war concerns having abated? So that will be All right, Vinod, thanks for sharing with us your outlook on the markets as well as sectors where you believe one can find value.